What's up, everybody? It is Michael Cadet from the Cadet Mortgage team at Cross Country Mortgage, and thank you so much for joining me today on this presentation. Today, I'm going to be walking you through a roadmap to purchase your first home. This is going to be geared specifically for first-time home buyers. This session should take about 45 minutes or so, 45 to 60 minutes. Really, this is going to arm you with the information that you need in order to take that first step in purchasing a home. So I believe that when you're coming against any fear or you're coming against any apprehension of taking a step towards something that you want to do, the thing that typically holds someone back is the fear of just not knowing. Of not knowing either the outcome, not knowing how to do whatever it is that you're looking to do. And today, that's what you're going to be getting today, is you're going to be armed with the know-how on how to do this, on how to purchase your first home. A little bit about me. Like I mentioned, I'm Michael Cadet. I lead a small lending team here in Petaluma, California, the Cadet Mortgage team, under the mentorship of Jeremy Forcier. He's a great mentor and good friend of mine. And essentially what we do, we help people put together home buying plans and help them achieve their home buying goals, whether that's purchasing a home, tapping into their equity, consolidating debt. There's a lot of different ways that we can help. I've been doing finance since about 2008 was when I got into finance officially. The best time, I always like to say, to get into finance. And I've worked at various different banks during that time. I've worked at places like Wells Fargo, at Union Bank, at US Bank, doing business banking, personal financial planning, and also commercial lending was my last stint at US Bank. So with that, it gave me a well-rounded education in terms of just finance, how finance works, how the banks look at borrowers, and how they underwrite, and just collecting all of that data over the years and being able to synthesize that into what I'm going to present to you today. So that's just a little bit about me. What I have done since I started my practice in 2018, the Cadet Mortgage team, is I'm taking a step back and I want to kind of revamp my mission. And that's not to say that I haven't been pursuing this mission since I've embarked on this whole journey, but I just want to revamp it, refresh it, and just recommit to my mission and my dedication to home buyers, which is more specifically first-time home buyers. So this is why I'm putting this together, and you're going to see a lot more content coming out from me and my team just regarding first-time home buyers and education on purchasing your first home. All right, but this presentation again today is just going to give you a full overview of everything that you need to know when buying your first home. My father was actually an architect in Haiti, and he was really the guy that gave me my inspiration when it comes to real estate and wanting to be getting into real estate. I originally wanted to be an architect, but my drafting teacher told me I couldn't draw a line straight, and totally crushed my dreams. But I quickly got over that and quickly realized that I have other gifts and talents that I wanted to tap into. So that's what led me into mortgage advisory. So I look at myself more as an advisor. I'm not here to try to sell you anything. I'm really here just to provide you with some information, and that way you can make the best educated decision for yourself. And if I can help in any way possible, then I'm here. I'm your guy. All right. Now, if you're thinking about buying a home, you are definitely in the right place. So thank you again for joining me for this presentation. That is me, Michael Cadet. There is all of my contact information. If you ever needed to get in contact with me with any of your personal loan scenarios, feel free to reach out to me. My contact information is all right there. So we've already kind of set the tone just in terms of what we're going to expect here. And again, this is going to be recorded, so you can go ahead and just leave any of your questions in the comment box, and I'll be sure to go ahead and get to those questions. And again, if you have any personal scenarios that you want to get to me, feel free to reach out to me as well. But today, what we're going to go over renting versus owning. We're going to go over the bonuses to buying. Then we're going to assess your current financial situation and then put together a financial plan. Then we're going to do a mental and an emotional check. We'll go into what that all means. Then we'll do a financial checkup, and then we'll go over and through the whole home buyer roadmap. And then again, at the end, we'll leave it all open for questions and answers. So, renting versus buying. That is the question of today. So, what is really the bonuses to buying? So, what I want you to do real quickly before I jump into this is take a calculator out. Take your monthly rent, whatever that is. Let's just say it's $2,500. Okay, so $2,500. We'll take 2,500 and then just times that by 3,600, or excuse me, 36, not 3,600, but just 36. And what do you got? What I have over here, if I calculated 90,000, or excuse me, $2,500 by 36, is I get $90,000. Okay, $90,000, that's a lot of money. That's 3 years. 3 years of rent, $90,000 gone, just totally out the window. Now, that's not to make you feel bad as to you paying rent, but that's just to quickly show you like what is happening, what is going on right now with your finances. So some of the quick benefits and the bonuses to buying real estate is going to be the tax benefits, right? So you get tax benefits for purchasing real estate. I'm not a CPA, so please don't hold me to this. And of course, you want to go ahead and consult with your own personal CPA for your specific situation. But some of the immediate tax benefit that you do receive just by owning a property is the interest, the mortgage interest. So at the end of the year, the bank, the lender, your mortgage servicer is going to send you a form. It's called a 1098. It's a 1098 interest form, and they'll go ahead and send that to you. And what that form is going to have essentially all the mortgage interest that you paid for that year. So let's just say at the end of 2024, you get that 1098 form. Okay, that 1098 form says, hey, Michael, you paid $24,000 in mortgage interest for the year. So now, I might be wrong on this. Again, consult with your CPA. Okay, Michael Cadet is not a CPA. Consult with your CPA or tax advisor. But to my understanding, you can take that $24,000 in mortgage interest that you paid towards your mortgage for the year, and then you can take that amount and then reduce your taxable income. So let's just say you made $100,000 for the year. So now you have $24,000 that you paid on your mortgage interest for the year. So instead of paying interest, or excuse me, taxes on $100,000 income, now you're only paying taxes on a $76,000 income based on the $24,000 mortgage interest that you're able to use to reduce your taxable income. Okay, so again, check with your tax advisor to make sure all that's correct, but that's the way that I've come to understand it. Another great benefit to purchasing real estate is building wealth, right? You're going to be able to build wealth and build equity. That's really one of the main and biggest benefits, along with all the others, is building the wealth, building the equity. Okay, so I mean, one of the things that you have going on for you as you own and build your real estate portfolio is that what's going on is that you have pretty much a few things that's happening as you're building wealth with real estate. Okay, so if you have a loan, in most cases, most people will have a loan, every single month that you make a monthly payment, okay, on your mortgage, that's reducing the principal balance of your loan. Okay, so every time you reduce the principal balance of your loan, it's creating more equity. Okay, so it's creating more of a gap between how much you owe versus how much the property is worth, and that's where the equity is at, right there in the middle. Okay. You also, have the appreciation of the property. Now, to me, that's more of a gift. Market conditions can always change. They can go up and down, but over the long haul, over the long-term view of this, the property will most likely appreciate in value, if not stay steady. Okay, so you have those components, and then we just went over the tax benefits. So I mean, you have three main things, which is the property appreciation, the principal pay down, and then the mortgage interest benefits. Is really the components and the mechanisms that's building the wealth for you. All right. Now, the other thing that you get by purchasing your own piece of property is you get some pride. You get some pride in ownership, right? This is a big feat that not everyone gets to accomplish, and really most of the time, the reason people don't accomplish this feat is just because you either don't have the right information, or you just don't have the right people around you to help you take that first step, which is what we're doing today. Okay, so the pride of ownership goes a long way because just living, specifically even living in a neighborhood where you can easily see that the neighbors, the community takes pride in their community. It shows in the front lawn, right? It shows in the upkeep of the property and the community. Right. And so by doing that, that maintains the value of your real estate, that maintains the value of your asset. And so you want to definitely be in an area where other people are taking pride in their ownership because it just reflects in the quality and the beauty of your community and the values that's coupled with it. Um, Also, the other bonuses to purchasing is you create a lot of stability for yourself and for your family. This is something, if this is for a purchase for you as a primary residence for your first time purchase, this is going to be a purchase that's going to, hopefully be the home that you raise your kids in, maybe even have your first child in. A home that where, family members, if they come from afar, can come and stay with you. You have a nest egg, you have a home, that's going to be a place of refuge for you and your family, and anyone alike that's within your circle and folks that you care about. And lastly, I mean, it's yours, right? It's yours. You can do whatever you want with it. I mean, besides like trying to burn it down, of course, but I mean, within reason, it's your property. Okay. If you want to paint the interior walls neon, yellow, have at it. Okay. If you want to have, crazy spaghetti fights and throw tomato sauce up against the wall, dude, go at it. Okay. It is yours. You can have some crazy pets in there if that's the way you want it. Just no crazy like giraffes or anything like that. But essentially, it's your property. It's your home. Okay. So these are some of the benefits. Okay. That we just quickly want to go over just to remind you this is what you're getting when you're purchasing your home. And you're not getting all of this when you're renting, unfortunately. Okay. What you're really being left with when you rent is just really a big bill at the end of the day. Now, granted, you do get shelter, and that's great. That is fine. And there's nothing wrong with that. I mean, we all are in different, stages in our life, and shelter is an important thing, right? I mean, we need shelter, we need food, we need transportation. So, shelter is important. All right. But just keep in mind as to what else is subtracting from you when we're thinking about this holistically. One of the first steps that you definitely want to take when you're purchasing your first home is that you want to do a mental and you want to do an emotional check. Now, it does come with a lot of responsibility once you own the home. All right. Now, even prior to owning the home, just getting the home is another, feat that you must overcome. Okay. Because First step, of course, is going to be getting pre-approved. Next step, then is going to be out shopping and trying to get your offer accepted, right? So it's going to take a little bit of mental fortitude to be able to just stay focused, stay strong, and just see your plan all the way through, right? There may even be a few letdowns along the journey. Let's say if you get outbid of a property that you were really eyeing and you could really see your family and yourself in, you just have to be able to move forward and keep moving forward until we get the goal of purchasing the home, getting you under contract, and getting you those keys. Now, the earlier that you can sit down with a mortgage professional to really go over your whole plan, your whole finances, the better, because that's really going to ensure that when it's actually time to put together your offer, that you're ready, that you have nothing to think about in terms of am I okay with my offer? Do I qualify? Like making sure that you sit down with a mortgage professional prior to making an offer, I would say is essential. Okay. It gives you a good idea of what you're qualified for, your purchasing power, and just gives you the confidence just to know, like, hey, this is my budget. I know for a fact that we've checked all these boxes already, and we can confidently go in and make an offer at whatever set, purchase price that you're aiming for. Um, so another good few questions that you want to ask yourself as you're kind of going through this whole mental and emotional check is your why. Um, why you want to think about making this move. Because, answering that question of why, and that comes up a lot in motivational talks and things like that when people are trying to find motivation. But it's a true component and as to what is necessary to keep in mind as to what's your why. Like, why are you even doing this? Why are you making this purchase? Is it going to be due to a job replacement? Is rents on the rise? Are you growing a family? What is it going to be for you? And having just a clear understanding as to what that is, I think is very important. That way, it's like when we come across if we come across any challenging points in the journey, we can always reflect back to our why to help us keep going and just to be able to draw strength from as to, remind us as to why we're doing this, right? Few things you want to also check out is, are you going to be planning on staying in the home for a few years? This is a good just check as to, if you plan on staying in the home. This could really impact the decisions that you make. If it's going to be for short term, maybe it doesn't make sense to get into a condo and have to pay an HOA fee if you decide to, move out or sell or something like that. Maybe it doesn't make sense. Maybe it does. It just really depends on what your situation is. Are you going to be purchasing this property with just by yourself, or are you going to be purchasing it with a partner? This is a conversation you really want to have with you and your partner prior to taking this step. And this is something that a mortgage professional like myself can help you with, and we can have this conversation family style. That's the way I like to do it. We can all just hop on a Zoom or just all sit down and just hash it all out. Okay. And then, how much work are you willing to put into a home? All right, is a good question too, because like I mentioned, it's a big responsibility. You're going to be responsible for this big asset now, right? So if the pipes burst, it's going to be on you. If the roof starts caving in, it's going to be on you. Not to say that you have to be a plumbing expert or you need to know how to fix roofs and start climbing up on roofs in the middle of the night, but you just need to be resourceful and be able to manage any type of maintenance issues and anything that is that goes on with your property. It's just like a car, you have to take it in to get maintenance that goes through use and abuse, over time. And certain things just kind of just go through the natural wear and tear of use. So just, be mindful of that. And again, these are the questions that you're asking yourself as you're doing a self-assessment. This is really just more of a self-assessment to get a gauge as to, am I ready for this? right? Am I ready to take this first step to home ownership? And these are the questions, the internal questions that you definitely want to just take a look at, check out, and just get in touch with. All right. Now, financially, it's a good idea to think like a lender, okay? Because lenders, they're not going to hold no mercy, right? They're there to make sure essentially that you have the ability to repay whatever loan that they're extending to you. So they're going to take a look at a few different components when it comes to your personal finances, right? So all of these are important, and I think that you should look at this anyways, just as a responsible, financial human being, in terms of just your financial well-being. So a few things to take a look at, right? So we're going to take a look at your credit, your monthly survival number, very important, cash, income, and then your debt to income ratio, all right, your DTI. Okay, so your credit, the higher the score, the better the rates, the greater the options that you have. All right. Kind of just, pretty much says it all in itself. The higher your credit score, the better the rates and greater the options that you'll have. All very true. Okay, so if you have a higher credit score, honestly, I would say anything above a 740, you're not really going to get much improvement in terms of like the rates and all that stuff. So like a 740, really it's like a 740 between a 760 is like the best that you're going to do in terms of how the bank is going to look at you. And they're not going to give you that much more of any breaks if your credit score is above 760, honestly. 740 will get you there, 760, that's kind of a no-brainer to most banks. Um, Also, just like by having more or just a higher credit score, it does open you up to more options, as it's saying. So, and what it's saying by options, meaning more products. So if you need to explore products that are outside of the realm of conventional financing, so more like conventional or FHA financing, then the requirements to qualify for products that I would call a little bit more exotic or creative, are just gonna be a little bit more stringent. So that sometimes they're gonna require that the debt to income ratio be a little bit lower, or the credit score needs to be a little bit higher. Um, or you may need to be required to put down a larger down payment. So the more creative that we need to get with your financial picture, the more requirements that the bank is going to have. All right, so just keep that in mind. Now, the monthly survival number, how much does it cost to be you every single month? Okay. So this number essentially represents everything right now that it takes to operate you as a human being. So that's things like your phone bill, your electricity bill, your car payment, your cable bill, all of that. What does it cost to be you? So have that number. That's a number we'll kind of go over when we look over at the budget. Um, After putting aside 6 to 12 months of your MSN, monthly survival number, how much can you put toward the down payment? Do you have consistent earning history? This is something the bank will look at. They're going to take a look at your employment history. So typically they're going to look between like 1 to 2 years. Typically it's 2 years. Then your debt to income ratio, a very, very important component. So your debt to income ratio, which is pretty much a look at your total monthly debt obligation. So you get the monthly payment. Okay. So not the whole balance, just the monthly payment. So your total monthly debt payments for the month. And then we're taking a look, against your total gross monthly income. Okay. So that's pretty much what the debt to income ratio is. Comparison between your total monthly debt payments compared to your total gross income, monthly gross income. What makes up your credit score? Okay, so a credit score or FICO is a three-digit numerical evaluation ranging from 350 to 850, assessing your credit worthiness based on credit history and current credit accounts. The score, along with your existing debt, income, and employment status, is a factor of your mortgage approval. So let's take a look and see what is going to go in to your credit score. New credit, meaning new credit that is being established. So, like a new credit card or a new car loan or student loan or something like that, represents 10% of your credit score. Okay, so 10% of your credit score is going to be represented by, um, new debt that's established. Okay, so an impact, but not much of an impact. Okay, types of credit used. So the types of credit that are used will have a pretty much of a small impact as well. So the types of credit used will have an impact as well. So some of the types of credit that the bank will consider as credit will be like revolving lines of credit. So these are things like your credit card or lines of credit, personal lines of credit, home equity lines of credit, things like that. Um, and um, and then versus like installment loans. So installment loans are going to be like more fixed loans. So just like an actual just loan with a balance, and you're just paying that principal and interest every single month. With a revolving line, you can pay it down and then reuse it, just like a credit card, right? So those are different types of credits that are used. That has a 10% impact on your credit score. All right. Length of credit history. So that has 15% impact on your credit score. So you can see this is incrementally going up in impact. So 15% impact on the length of credit history. So lenders typically want to see trade lines with a credit history of at least between like 1 to 2 years. That just shows that you have been paying your obligations and you have a history and a track record to show that. Okay, so they're just looking for a track record to show, hey, this guy or this gal pays her debts back. She pays her obligations back, and she has a track record to show that. That has a 15% impact on your credit score. Okay. Now here's where we get to some of the areas where it has of a more heavier impact to your credit score. So the amounts owed and your payment history. Okay, so the amounts owed and your payment history are going to have the largest impact on your credit score. Okay, so how much you owe has a 30% impact on your credit score. And your payment history has a 35% impact on your credit score. Okay, that's huge. So just in regards of amounts owed, um, it's okay to have a big balance, owed out there, as long as you're making your payments on time and the proportion to its limit. Let's just say you have $1,000 credit card with $1,000 credit limit. Now, if you're close to maxing out the credit card, let's say you have a balance of $999.99. Well, the amount owed in proportion to the credit limit, is very high. So that would have more of a negative impact on your credit score. Now, let's just say you have a $1 million mortgage. Okay. Now that would more be considered a positive impact on your credit, just because it shows that, well, for one, it's not a revolving line, right? So, that we've talked about the types of credit used, which is revolving or installment. A mortgage loan would be considered an installment loan. Okay, so we're paying principal and interest on the loan. It's typically a fixed amount. It can be variable, but typically they're fixed amounts, and you're paying them back over, an X amount of time. In this case, a mortgage, 30 years. Okay, so this would have more of a positive impact on your credit just because it's a large amount, it's an installment loan, and you're paying it back on time. Okay. And it just shows lenders and banks that, hey, this person can be trusted with $1 million and he's going to pay us back. So, of course, we want to go ahead and, yeah, we'll do business with him and we'll give him a good credit score because of that. Right. So, those are just kind of different ways how the amounts owed can either have a negative impact or a positive impact on your credit score. Um, and then your payment history also has a huge impact, one of the largest impacts on your credit score. So the payment history, the bank will look at it from, 30 to 60 and 90-day plus lates. Okay. So if you, let's say, have missed a payment and you're 30 days late on a credit obligation, that will negatively impact your credit score. Okay. Now, for late payments, they typically take almost 7 years to fall off of your credit. Okay. So you don't want to be late on your credit obligations. Now, let's just say you have a credit card and you're past the 15-day, mark where they'll assess you a late fee after 15 days. Now, this is not me advocating that you pay your credit cards late because you don't want to incur any type of fees with that. Okay. But what I'm saying is that it won't negatively impact your credit score if you pay past the 15 day mark. You'll get a late fee, which I don't advocate because you want to keep the money in. You don't want to, have money be going out for no reason. But the 30-day mark is really where it really hurts you because after 30 days, this is when whoever you owe the money to, whether it's, a credit card or a car payment or something like that, after 30 days is when they will go ahead and report that late payment to the credit bureaus. And once it's reported to the credit bureaus, it sticks on your credit report. And that credit report is what the banks and any other lending institution is going to refer to when they make a decision on lending you money. Okay, so 7 years, long time. You definitely don't want to, miss any late payments. And know things happen, but just try your hardest. And then once you get past like the 30 days, that gets reported. If it reaches 60 days, that's 2 months of being late. That gets reported and further just damages the credit. And then 90 days, typically the debtors are either seeking collection methods or have already just sent your accounts into collections, and then that just has a whole other impact on your credit. Okay, so like I was mentioning before, the credit score. So a 740 plus, excellent credit. Anything above 740, like I said, you're most likely not going to get that much more of a credit break out there. So 740, the bank is looking at you like you are A plus. Okay, we are going to pretty much give you whatever you like within our means. Now, between the 680 and the 739 is very, very good. Still creates um, a lot of ease with you obtaining any mortgages, still puts you in the box of being able to qualify for creative products as well, and still be able to get really great rates. Okay. The 640 between 679 scores, this is where you can still qualify for like first time home buyer programs within this range. More of in the 660 range is where you want to be for first time, home buyer down payment assistance programs, more specifically. Um, but within this range, it's most likely something in there may be being impacting your credit score. So we may need to take a look and see what's going on within your credit and just profile and see if you just have everything that we need in order to get you qualified for a loan. Now a score below a 640, so a 639 and lower, tends to lead into more of a challenging territory. Okay. It's not to say that we can't qualify you with a score below a 639. It just indicates and starts to flag that, hey, this person may have some things going on with the credit. And it just will take a little bit more work to get this person approved. And this typically will put someone like more in the FHA category, and we'll go into what that means a little later. But as I was saying, tips on making sure that that credit score stays in an area that qualifies you for more products. Pay your bills on time. Try not to apply for too many credit lines because every inquiry does impact the credit score. Try not to max out the credit cards. If you have $1,000 limit, don't try to max it out to $1,000 or $999.99. Try to keep it within a $300 balance. That's 30% of what that available credit would be if you had $1,000 credit line. And then keep your credit lines open. Okay, so a mistake that some people make sometimes is that uh, they think that in preparation of purchasing a home, that they want to clean up their credit and they want to get rid of like any old credit cards, no credit card debt, and then they close out the credit cards. And a part of what's going into your credit score is the length of time that you've had lines of credit or open credit. So keep those old credit cards open, because that's going to definitely help your credit score. So just a quick tip, 1 in 5 Americans find errors on their credit reports. Credit report mistakes can lead to disqualification, so monitor your own credit score as this could influence your ability to get a loan. So one thing I like to do every time when I pull a credit report for a client is we'll go over what we call a pre-approval call, and or even a cleanup call. Um, let's cut that. So a quick tip from the Cadet Mortgage team. So 1 in 5 Americans find errors on their credit reports. Credit report mistakes can lead to disqualifications. So monitor your own credit score as this can influence your ability to get a loan. So one thing that I like to do, and something we have within our process, is we do what's called a cleanup call. And so after we pull your credit, we'll do a cleanup call to go over your credit, make sure everything is accurate on the credit report, along with other things that we're going over within that call. But one important thing is to make sure that everything being reported on that credit report is accurate. Sometimes old names can show up on there if you're married before, old addresses that may not, be relevant to what we're doing, presently, may still be showing up there. And then even old debts sometimes that are either in collections or old debts that have been paid off, that are still being reported for whatever reason. That too sometimes gets on there and just needs to be addressed. Right. Sometimes people are just like, what? I thought I paid that off. I didn't even think that these people were still reporting that I owed them any money. So it's an important step that we take just to ensure that everything that's being reported is being reported correctly. Because if it's not, that could be negatively impacting your credit score and, not getting us the score and qualifications that we want. So we briefly spoke about your monthly survival number earlier. So this is just a quick little worksheet just to show you um, uh, what a worksheet would look like. Essentially, it's just a budget. Okay, so it's a budget, and I can send this to you. I'll drop a link as to where you can get this. But this is a budget form to calculate and track all of your expenses for the month. Okay, so this is going to go and capture like your monthly rent, student loans, credit cards, home utilities, phone bill, dry cleaning, daycare, cell phone, insurances, all that stuff. And then even calculate what you're contributing towards your like IRA account, 401k, your retirement accounts and things of that nature. So whatever all that is, total all that up and then times that by 6 or times that by 12. That's how much you should have in savings. Okay. That's your survival fund. So if let's just say someone in the household loses their job or they get injured, God forbid, knock on wood, that way you have at least 6 months or 12 months worth of funds set aside to be able to at least just pay your bills and you don't have to worry about it. That should be a goal really for everybody to start working on their MSN, on their monthly survival number. Okay, and start to work towards putting aside that money for 6 months. And let's say you get to the 6 month mark and you're like, hey, you know what? I just saved 6 months worth of MSN. I got my MSN saved up. I'm good, Coach Cadet. Cool. Well, hey, you know what? Let's do another 6 months. Okay. Let's do another 6 months of MSN. And that way you have 12 months. So that way, if anything happens, you got 12 months that you can fall back on. Not only do you have 12 months that you can fall back on, but let's just say an investment opportunity pops up and you need to be able to act quick. You have that money set aside now, right? So it's an important thing just in personal finance, period, to have those emergency funds set aside. It'll definitely ease a lot of anxiety, and really it just really promotes good financial stewardship. More loans for more flexibility. So you have more options to buy your first home with less out-of-pocket expenses. Okay, so in today's world, there's options for first-time home buyers. There's down payment assistance programs. Being a first-time home buyers actually breaks the myth that you need 20% to purchase your first home. That's not the case. I mean, in most cases, you really only need about 3% to purchase your home. So I'll go over really the typical loan programs that you'll come across when you're taking that first step to purchase your first home. So the first product or loan program that we will always try to fit you in, just due to the uh, just due to the rates and qualifications is the conventional mortgage. Okay, let me start that over. So the first loan program that we'll go over is the conventional mortgage. So the conventional mortgage is the typical program that most people will try to qualify for. This is your standard 30-year fixed mortgage. You can qualify for this program with as little as 3% down as a first-time home buyer. So if you're, let's just say, trying to purchase a $500,000 home, or, let's just in California, the Bay Area. Let's just be a little more realistic. Let's just say you're trying to purchase a $700,000 home here in the Bay Area. Well, what you're going to need for a down payment is going to be $21,000. That's going to be the down payment, and then plus your closing cost. Now, in terms of seller credits, meaning the amount that a seller is able to contribute towards your closing cost is maxed out at 3% when you're using a conventional mortgage. Now, going down the line here, looking at an FHA mortgage, the minimum down payment for a first-time home buyer, really for any home buyer, is going to be 3.5% down. It's the minimum down payment. Now, sellers can contribute up to 6% of the sales price towards the closing cost. Now, this comes in handy in the event that your real estate agent needs to negotiate on your behalf. Let's just say you may be a little short on your closing cost, and your agent can negotiate on your behalf to have the seller help pay for your closing costs. Even in some cases, pay for all your closing costs. Um, there's VA loans. These are loans that are specifically geared towards our great veterans. So these loans offer 100% financing. Also a great option for a first-time home buyer, more specifically for our veterans. And then for USDA, so these are loan programs that are for properties located in rural areas. So in rural areas, we can offer 100% financing for these types of properties. Now, to determine if the property falls within a rural census tract, we just need to go on our census map and just look to see if it falls within a rural census tract. Once we determine that, then we can determine, hey, we can qualify this particular property within a rural area for USDA financing, which would offer 100% financing. Another great option for first-time home buyers is a strategy called the buy excuse me. Another great strategy for first-time home buyers is called the buy down strategy. So there's many versions of the buy down strategy, and I'll walk you through each one of them right now. So the buyers, excuse me, the buyer excuse me, the buy down strategy essentially it gives a buyer a temporary buy down by giving you a lower rate and a lower monthly payment at the start of your loan. Now, the seller provides the savings through an upfront deposit, so there is no cost to you to the borrower. So, like I was mentioning, and just depending on whether you decide to go with conventional financing or if it makes more sense to go with FHA financing, will determine the amount that the seller will be able to contribute towards these closing costs. Now, for conventional, 3% of the sales price, FHA, 6%. If we're putting the minimum down payment, which is 3 to 3.5%. So the buy down options works like this. So we have a 1-0 buy down. So essentially, what that means is you're saving 1% on the interest rate for 1 year. Okay, so you're saving 1% on the interest rate for 1 year. Now, the 1-1 buy down is that you're saving 1% for 2 years. So, 1% year one, 1% year two. Then you have a 2-1 buy down where you're saving 2% in the first year, and then you're saving 1% in the second year. And then you also have a 3-2-1 buy down where you're saving 3% in the first year, 2% in the second, and then 1% in year three. Okay. Now, this strategy can afford you a lot of savings. And if you're of the mindset that you think rates are going to fall within the next few years, then this will be a great strategy because this will be able to afford you a lower rate within the first few years of owning the home. And then in the event, if your, prediction serves you right, then in the event that rates fall, then you can just go ahead and refinance into a fixed rate at the lower rates at that time. Now, let's just say you were, working with one of our, fabulous agents that I work with, and they were able to negotiate a 3-2-1 buy down for you. So they got the seller to go ahead and contribute enough to cover the 3-2-1 buy down. So you're taking advantage of 3% savings in year one, 2% in year two, and then 1 in year three, right? Now, let's just say that interest rates fall within year two, right? So the amount of cash that is being used to pay for this buy down is placed in an escrow account. All right. Now, in that escrow account, every single month that you go to make your payment, you're going to make the payment at the discounted monthly payment. Okay. Now, the difference, whatever's left over, whatever's remaining, to be paid is pulled from that escrow account. So if in year two, you come to the conclusion and say to yourself, hey, I think rates are going to are at a point where I feel comfortable refinancing, there's going to be a cash balance in that escrow account. Okay, so you can take that cash balance and you can use it to refinance and put it towards your closing cost. You can use it to buy down your interest rate even further for at the fixed rate, or you can even take that cash and use that to reduce your principal balance at that time. So it's a great strategy to explore. If you want to learn more about it and if you want to run a few scenarios specifically for you, reach out to me. Okay. It's a great strategy. You definitely want to understand how that works. And I may run another session just to show you specifically on how the 2-1 buy down works. Okay. So all that is to say that home ownership, it's within reach. It's within your reach, and you can have home ownership within your reach even with less cash. Now, like I was mentioning, we offer national and state down payment assistance programs depending on the program. These can be grants or low zero interest loans. These can be assistance forgivable over time or due when you sell the property. And this can even be cash available for your down payment or just for your closing costs. So it is within reach for you. All right. We have the resources to help you get into your first home. So like I was talking about earlier, we went over a few of the different loan programs, but we'll take a look at this rubric to kind of see the differences and what the qualifications are for each type. So we have your conventional loan, like I mentioned. Minimum down payment is going to be 3%. Maximum loan amount is going to be up to $726,200. Now, that's going to vary depending on which county that you're purchasing your home in. So from county to county will determine what the maximum loan amount is to qualify for conforming loans, for conventional loan. All right. Anything above that will either fall into a jumbo loan or what's called a high balance loan. And of course, we can talk later about that. But also this has let you know that you can receive gift funds for conventional financing. So gift funds can come from a friend, a family member, and that could be put towards 100% towards a closing cost or even the down payment. And then you have your government loans, which we went over, the FHA, VA, and USDA. Minimum down payment is going to be between 0 to 3.5%. Um, like I mentioned, loan limits are going to depend highly on the county that you purchased the home in. Me being here in the Bay Area, we live in what's called a high cost area. So a lot of the homes here are in the millions of dollars. So the loan limits are going to be a little bit more higher versus an area that may be a little bit more rural and not as densely populated. Okay, 100% of gift funds can be used for government loans as well. It could be put towards the closing cost and the down payment as well. Now, jumbo loans, these are going to be loan amounts that are above what those county or maximum loan limits are. So, like if it's above the 726 limit for a one unit property, then it would fall into what's considered a jumbo loan. So, minimum down payment is going to be 10% for jumbo loans. Lots of other lenders will make you put at least 20% down. These typically are larger loan amounts, and so the bank to offset and mitigate their risk will require you to put a larger down payment. So even if you're living in a high cost area as a first time home buyer, you still have a resource with myself and our team to put as little as 10% down on your first home, even in a high cost area. Okay. Maximum loan amount for these are going to be about $5 million. Do we do loans above $5 million? Yes, we can. Does it happen every day? Absolutely not. Not everyone's walking around seeking a $5 million loan, but we can. It just becomes something outside of our, original wheelhouse and something we just had to get creative on. But for jumbo loans, maximum loan amount just for the just for the sake of what we're talking about here, 5 million bucks. Gift funds can be used again for this. 100% could be used towards your closing cost or your down payment as well. All right. Another cross-country mortgage tip is while calculating your down payment, remember to include closing costs. They can add up to thousands of dollars, typically 2% to 5% of the purchase price of your home. So you may want to also budget for moving expenses, repairs, and renovations. So that is a good tip. Keep that in mind. 2% to 2 to 5% of the purchase price is typically where you want to budget for your closing cost. All right. Now, speaking on closing cost, what is closing cost? What goes into your closing cost? So what can add up to 2 to 5% of your purchase price? I mean, that is a lot of money. So again, if we're looking at a $700,000 property, you're telling me I need to come up with an additional $35,000? Maybe. maybe not, but let's just see what goes into it. So typically what's going into your closing costs are going to be things like your home inspections. So you want to inspect one of the largest assets that you're going to be purchasing. Okay. So there are companies that you can hire. Your agent will most likely work with you on this particular aspect in which they will have a home inspector, and hence the name home inspector. They will go inside the home and inspect the home. So things they're looking for is, the structural integrity of the property to make sure that the property is structurally sound. So there's no like foundation issues. There's no like cracks in the wall to indicate like the foundation is messed up. They're going to check the roof to make sure the roof isn't going to cave in on you, things like that. So a home inspection is a cost that's associated with your closing cost. An appraisal essentially is a report just to essentially is really more for the lender, but also for you as well. So you get an accurate and professional assessment of the value of your home. So they're going to take a look at what other properties in the area have sold for that are similar to the property that you're looking to purchase, and also just kind of give you a nice, good report on the property. Because again, this is an asset of yours that you definitely want to have an understanding of what the value of that asset is. So that's the document to prove what that value is for yourself, and also to satisfy the requirements to the bank. Homeowners insurance, need homeowners insurance to satisfy loan requirements. An attorney, and if you have like, if you live in a state where attorneys, handle the closings, then that can be a cost. Then you have your lender fees. Lender fees typically come out to like, underwriting fees, processing fees, and they typically will come within maybe about like 15 to 1700 bucks or so, which is pretty reasonable. And then you have your title fees, so your title and escrow, just to make sure that you have clear title, transfer taxes, property taxes, and also any like prepaid interest. Okay. So those are the costs that are associated with closing a loan transaction. All right. Um, so moving along just into the portion, we'll discuss what the bank is looking at when we're looking at your income. Okay. So we'll quickly just go over this real quick. So your income, to assess your ability to make payments in the future, we will review your pay stubs and tax returns for the last 2 years to ensure your income has been consistent and stable. If your income is variable because you're self-employed or paid on commission, that's okay too. We'll likely request additional documentation. So this is a very important component in terms of qualifying for a home loan. What the bank is looking at is really when it comes to your income, do you have consistent earning history? Typically, we're looking at between 2 years is where we like to be. So if you're like a W-2 earner, we're gonna ask for the last 2 years of your W-2s, or if you're the 1099, we'll ask for the last 2 years of 1099s. But again, like I mentioned before, the more creative we need to get, the more we need to put in. So like if let's say I've only been working for a particular place for 1 year, and I'm new to this industry, and yeah, we can maybe find you a program to qualify with only a 1 year work history, but now we're going to need to have you put more cash in, just because conventional financing just won't cut it for that type of scenario. But there is still solutions. So um, again, just the more that we have, the more creative we can be. So um, quick little tip. If you're in the loan process, don't change jobs if you can avoid it. Lenders are required to ask about gaps in your employment history. Now, like it said, if you can't avoid it and you need to change jobs, I was literally just dealing with a client in this type of situation, um, then do what you have to do. Okay. It's just going to require a little bit more documentation and work on everyone's part. And of course, myself and our team is more than willing to go above and beyond for you. But just keep that in mind, because the last thing I want is to create frustration for somebody going through this process. So that way, you know what to expect. If you are changing jobs in the middle of a loan, that it's just going to require a lot more documentation. Well, let me take that back. Not a lot more, but just added documentation. Let's just say. Um, but if it is inevitable, like I was saying, do what you got to do, but tell us as soon as possible. That's just something that we really need to know up front, or just as soon as you possibly can let us know. That way we can make the arrangements that we need to make to ensure that we get you into that loan. Another very, very, very important component when determining how much of a loan you can qualify for is your debt to income ratio. So this is the ratio of your monthly debt against your income. We talked about this earlier. So typically, the lower your DTI is, the debt to income ratio, the more financing options that you have. All right. So your debt to income ratio, monthly recurring payments, plus okay, sorry. So monthly recurring. So in this diagram, it's showing like monthly recurring payments, student loans, car payments, and all this, plus your monthly housing payment. Essentially, the new housing payment that we're proposing, the one that you're trying to qualify for, um, is what we're going to look at. Okay. So looking at this diagram here, it's essentially showing you what the bank is going to look at when calculating your debt to income ratio. So what the bank is going to take a look at is when we pull your credit report, the recurring payments, the recurring debt obligations that are showing up on your credit report is what is going to go into that debt to income calculation. So things like your student loans, car payments, credit cards, personal loans, things like that is what will count, towards your debts and your debt to income ratio. And then plus the new housing payment that we're proposing for you. So whatever new housing payment that we're trying to get you qualified for, along with those recurring payments, is what we would total as your total monthly debt. Everything else, like groceries and light bills and things like that, that's not going to get counted into that. Okay, because as the bank is figuring, hey, you're not going to be obligated to that once you move. So that's all that they're counting. Um, as I said, the lower that debt to income ratio is, more options that we have. So another quick little cadet mortgage team tip is keeping your debt to income ratio low will help ensure you can afford your debt repayments and give you the peace of mind that comes from handling your finances responsibly. If you can also help It can also help you be more likely to qualify for credit for things you really want in the future. Now, ways you can reduce your DTI: increase your income, you can pay off your debt, avoid taking on more debt, and postpone large purchases. Recalculate your DTI monthly to see if you're making progress. That's a credit mortgage tip for you today. All right, so let's take a look as to what goes into your monthly payment. So there's a few components that goes into what makes up a monthly payment. So there's going to be an acronym that I'll share with you that is very popular. It's called your PITI. So your PITI. So that represents your principal, your interest, your taxes, and your insurance, which is like typically your homeowner's insurance. And in some cases, it could be even an association fee, like an HOA. All right, so I'll walk through what each of those mean. So the principal portion of the monthly payment is the portion of the amount that's borrowed or the remaining unpaid balance. So the principal, that's the loan amount. That's the principal balance of your loan. Your loan amount is the money that we lend to you. So that's what the principal is. The interest is the amount charged by the lender for borrowing the money. So essentially the cost for borrowing the money. Okay, so that's the interest. The taxes, that's the amount that's going to be charged by the municipality. based on the value of the property. So whatever city or municipality that you live in will do their own city or county tax assessment, and whatever that assessment is, they'll assess what that value is in their opinion, and based off of that value is what they'll tax the home on. And so that's what is another component that goes into the monthly payment. And then another requirement of the bank is that you have homeowners insurance. And homeowners insurance is a policy that protects you against financial loss in the event of property damage. So, in the event of any type of natural disaster, earthquake, or fire, or things like that, will fall within this category. Now, there's different types of insurance um, that is offered by insurance companies, and once you get to that point, an insurance provider will be able to kind of guide you in that direction. Okay. Now, additional cost, like I said, there might be some other costs associated, but that's typically what you'll encounter is the principal, interest, taxes, and insurance. Now, some other cost that you may encounter is going to be your mortgage insurance. So, in the event that you're putting less than 20% down, the bank is going to require that you put mortgage insurance. Now, mortgage insurance is a contract that protects the lender. Okay, this is a key thing. It protects the lender. This is not something to protect the borrower. So the mortgage insurance protects the lender against loss caused by a borrower's default on a government or conventional home loan. So in the event that, let's say, a home borrower cannot repay the loan that's been extended to them, the mortgage insurance provider will make the lender whole. Okay, this came out after the whole 2008 debacle when thousands of banks went under for giving out loans that were just too risky to borrowers that didn't, exemplify an ability to repay the loan. So to protect the banks and to protect the integrity of our industry, this is a practice that has been implemented to ensure that banks aren't overextending themselves and putting in themselves into a position that could, unfortunately close their doors. Uh, Private mortgage insurance, or excuse me, I skipped one. The mortgage insurance premium. Now, this is the amount paid by a borrower for mortgage insurance until a certain equity level is reached. So this is what you'll find uh, in FHA mortgages. So FHA mortgages have an upfront mortgage insurance premium. So it's at like 1.75%. You can pay that out of pocket if you want to. It just adds to the cost of your closing cost. Or you can just roll that specific cost into your loan for FHA mortgages specifically. Um, and so uh, so what I pretty much went over prior in terms of having less than 20%, that's the private mortgage insurance, and then the mortgage insurance premium is what I just went over. So again, just so I'm clear, just so we're clear, there's two types of mortgage insurance. Uh, there's two types of mortgage insurances. Okay, there's the mortgage insurance premium. Okay, that's where the amount is paid by the borrower for mortgage insurance until a certain equity level is reached. That's typically for FHA financing. And then you have private mortgage insurance, so your PMI. This is the mortgage insurance to protect the lenders against loss in the event that the borrower defaults. That got put into place after 2008 and the whole 2008 debacle unfolded. And then other costs that you may encounter is homeowners association, which I mentioned a moment ago, but homeowner association dues. So if you are purchasing a condo and some type of condo, unit, most likely you're going to come across, homeowners association fees. Now, as we take a turn into the Homebuyer Roadmap, Purchasing a home, it can seem like a complex process, especially for a first-time home buyer. So we're gonna break down six major milestones that's gonna help you navigate this road to home ownership. As your partner, I will be here every step of the way, so you don't need to worry. Michael Cadet is here to help. All right, so let's just get a quick understanding as to who is who in this whole process. So who's going to be the characters that are going to play in helping you purchase that first home. So these are going to be the team members on your road to home ownership. So you're going to have me, your your loan officer, guiding you through all of your financial options and guiding you through the loan options to help you purchase the home. Then you're going to have your real estate agent. Okay, your real estate agent, that person's going to help you, go over inspection reports. They're going to help you go over contracts, help you negotiate terms on your behalf, and essentially help communicate and facilitate your wants and your desires to sellers. All right. Then we're going to have the appraiser. The appraiser is going to be the professional who comes out and gives a valuation of the property to show you and the lender what the value of the property is. And the value of the property is going to help determine the loan amount that we give. All right. In states where attorneys are required to handle closing, you'll encounter an attorney. In California, that's not the case. In other states, I think in Missouri, places like that, Georgia, you're gonna encounter an attorney. Your title company, that's going to be uh, the folks that are going to ensure that the property that you're purchasing has a clear title. So meaning that you have clear ownership to this property. There's no impeding claims to this property that's going to prevent you from taking ownership of that property. So title is there to help facilitate that and to give insurance that that is the case, that this property that they're helping transact is going to be yours and is being taken from someone that actually owned the property to be able to sell to you. Home inspector, we went over that just a moment ago. That's going to be the person who comes out and inspects the property, checking for, foundation issues, roofing, just checking the quality and integrity of the property and structure and things like that. Then you'll come across a home insurance agent. So that home insurance agent is most likely going to provide you with with adequate insurance to fulfill whatever requirements are going to be required from the bank, and just to ensure that your property is protected. Okay, and then really the first step is to meet with me. You give me a call. I will actually drop a link in the description section here so you can click the link to schedule a discovery call. That is the first step. Okay. Nothing else really happens until we go through a discovery call. All right. And in that discovery call, essentially all we're doing is I'm just really trying to figure out how I can help you. Right. Every single person's situation is different. Everyone's unique. Everyone has a unique situation going on. People are at different stages in their life, and everyone needs a personalized, customized plan that fits specifically where you're at and where you're trying to go. And so that's the first step. So you want to meet with the lender. Even if you're not planning on moving, next month, meet with them as soon as you possibly can, because again, this is more about planning versus, just jumping into this thing. I mean, before we can actually execute something, we need to put together a plan. So this is why we emphasize this a lot. Because especially if we meet and we encounter or really uncover that in order to help accomplish your goals, we're going to need to be a little bit more creative. And so it's better to have an understanding of that earlier. So that way it's not a surprise when I'm like, hey, you know what, actually, due to your circumstances, we're going to need you to come up with 20% or even 25% for the down payment so you can get to the goal that you're trying to get to. And I just don't like surprises, and that just helps create a more fluid experience for everybody. Okay, but really, it's really about just again putting together that plan. So let's just make a quick determination between what what it means to be pre-qualified and what it means to be pre-approved. Okay, so we'll go over these definitions here. So a pre-qualification is a simple calculation of the amount of home you can afford. It's based on information you provide with little or no supporting documentation to fully assess your financial ability. Okay, so I can do a pre-qualification over the phone. You give me a call, I can ask you a few questions such as like your income, what your monthly debt obligations are, the last time you checked your credit score so we can get an idea of what your credit is, current balances in your savings and checkings accounts for your down payment and closing cost. And I can do some quick calculations, do what, calculate what the debt to income ratio is and see what you can qualify for. And then that's what that is. That's a pre-qualification. That's all that is. But at no point within that conversation have I seen anything. I haven't seen any documents. I don't know where your money is at. I haven't seen anything or verified that your cash is where it's at or your income is what it is. That's just based off of what you're telling me. And so that's what a pre-qualification is. Now, moving to a pre-approval. Now, a pre-approval, going off of the definition here, a pre-approval is a document generated by your lender, someone like me, supporting your ability as a buyer to repay your forthcoming mortgage. It often involves a complete loan application. It provides a summary of valuable information to your real estate agent, including the amount you can afford and other applicable conditions. So the pre-approval, as you can see, is a more in-depth investigation into your finances and gives a better and clear picture as to what you can afford. Okay, so once we go through the whole pre-approval process, that process involves us actually checking and fact checking everything that we qualified you on. So if you said that you made $120,000 annually, okay, well now we're going to go ahead and collect and capture your application, put that on the application, and then go and verify that the $120,000 is what you earn. That way we can ensure that you as the borrower have the ability to repay this loan based off of your income. So that's really the extra step, the more thorough step in the home buying process is being pre-approved. And when you have that pre-approval document, your real estate agent is going to be it's going to be an indication to your real estate agent that, okay, this person is serious. They've been vetted thoroughly. And that's the expectation from the real estate agent because, sometimes lenders, they don't vet thoroughly, but that's another conversation. But their expectation is that if you hand them a pre-approval letter, they have been vetted thoroughly. Okay. And so that's what we're aiming for with the pre-approval letter. Now, what are the positives to getting pre-approved? The positives to getting pre-approved is some of the things we just went over. So it's determining your budget, determining what your purchasing power is, essentially what the amount of home you can purchase, the current interest rates or range of rates are at the time, what your monthly payment is, and then how much cash you're going to need to close the transaction. And then just having that plan, your budget, is going to just help you shop for homes within that budget. So that way you're not looking at homes that are outside of the budget and outside of the realm of where you're going to feel comfortable at. Now, another a positive just by being pre-approved is that you gain greater buying power. So it's competitive as you start showing homes because right now in today's market, one of the challenges not only is affordability a challenge for a lot of first-time home buyers, but inventory. The inventory of homes available for any type of buyer out there is very low. So you want to stand out as a just as a qualified buyer who has a strong offer to present to a seller and who will be willing to go ahead and transact with you and get into contract. So, just being pre-approved and having all those ducks in a row is going to help you stand out to get your offer accepted. Okay. Because I've worked with people and, we've, put together, 4 or 5 offers, even with a pre-approval, and sometimes they don't get accepted just because maybe someone else is outbidding them, or it just wasn't the luck of the draw. Now, you can avoid setbacks is another positive by being pre-approved. So avoiding setbacks is a big thing. Like I said, I hate surprises. I don't like surprises when it comes to this. A birthday surprise, I can manage, but a surprise in a loan transaction, just not acceptable. All right. So by being pre-approved, it just helps avoid these setbacks and avoids surprises during escrow. That way you can just find out if there's like any particular quirks within your income or your ability to pull cash from, your retirement accounts. Or even if it's an account that you just recently inherited. Another pre-approval positive is that it saves you time. So it saves you a lot of time because in the event that you do find a property that you want to purchase and you want to pursue, it saves you time in the event that you don't have to go through the process of getting pre-approved because regardless of it, you're going to have to go through the hurdle of supply, filling out the questionnaire, supplying the supporting documents, going through the wait and turn times of receiving any data that we need to get back from either your employer, or just from processing. So that could take about a week or even 2 weeks, just depending on how fast you can get all your documentation in and, what the, turnaround times is for the bank at the time. So just getting all that stuff done ahead of time is a huge advantage to you and to the realtor who's going to be representing you to get your offer accepted. And that way you can just move speedily. And if you find something that you like right then and there, you can act on it immediately. Okay, so those are some positives of getting pre-approved. And that's the reasons why you want to definitely get pre-approved. Some of the documents that we will most likely ask is going to be like your pay stubs. So the most recent 30 days of your pay stubs. If you're paid monthly, just provide the most recent 2 months. Tax returns, and more specifically for people who are self-employed, we're going to definitely need your tax returns. But tax returns is something that we may ask for. So the most recent 2 years as well. So this could be your tax returns if you're a W-2 employee, or if you're a 1099 employee. So if you're like an independent contractor, like a barber, or you drive Uber, things like that. We'll definitely need to see your tax returns. Assets, so your asset statements, so your bank statements, 401ks, IRAs, things like that. We'll want to see at least 2 months worth of bank statements, just so we can document and show where the cash is going to come from to purchase the transaction. We'll also need a copy of your ID, just to ensure it is you that we're dealing with. And then we're going to do a credit check. And like I mentioned, once we pull in the credit, then we'll do a cleanup call and go over that credit report with you together. And main things that we're making sure in the credit, like I said, everything is accurate in there. Your last name, social security, things like that, all that stuff is accurate. We're just ensuring all that stuff is a-okay. All right, and then once we're through with that whole process, then you're going to go and meet with your agent to determine your wants versus your needs. Okay, so this is when you start the home finding process, when you start to search for homes. So you start to search for your homes, within 3 to 6 months before you intend to buy. Okay, so you're going in search of your perfect home 3 to 6 months before you intend to buy. Okay, so this will get you out there, seeing what's out there, getting you in the motion of putting offers and just kind of getting you geared up to embark on this whole journey of home ownership. Now, your agent, as they're helping you sift through the market and sift through your ideas and sift through the inventory that's available, they're going to help you they'll just help you frame your wants and your needs to be a little bit more realistic, let's just say. All right. So your agent can help you be realistic about perfect homes, right? So cosmetic fixes versus structural issues, property taxes, neighborhood crime rates, quality of the schools. That's very important. Proximity to major interstates and public transportation. So not everything is going to be perfect. All right. There's always going to be just something that's just a little off or a little blemish here and there. But just keep in mind that, in the game of real estate, it's mostly what's happening is people are buying and selling used homes. Okay. So not everything is going to be, perfect, 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 but the agent is going to just help shape that perception so you can kind of just see the value in what you're getting. Okay. Now, once you find the home, then we'll get to the segment of this journey to purchase the home, to make an offer. So once you've found that dream home, you've worked with your agent and you've negotiated the price and scheduled the home inspection and everything like of that matter, your agent is going to know how much other homes are selling for in that neighborhood and will fight for you on your behalf to get a fair and respectable price accepted. Okay, so that's their job. That's their job is to do the market research just to ensure that you're not paying or overpaying for a property that could very well be, a little less expensive, because of the homes that have sold in the neighborhood. Um, the inspection will also confirm if there's like any hidden problems with like the foundation, the plumbing, heating and cooling systems. Your agent is going to go through those reports and make sure that you're aware of this and also see if they can use that for leverage to see if they can get the seller to repair some of the things, reduce the sales price, or maybe even give a credit to repair those things on your own. And if another bullet point as you're making an offer, if you want anything that's not nailed down to be included in this sale, especially the appliances, it must be stated in the contract. Okay, so this is another reason why having your agent, on your team and just being in close relationship with that person, is that these are the things that they're doing for you. These are the things that they're working on your behalf for you. So they're looking, and they're skilled in just negotiating. That is an art form. I don't think that everyone is just born to be a negotiator, but just being able to kind of pick out these little nuances and present it in a way that is, fair for everyone, to make sure that you're getting the best asset that your money can buy, right? And that's what the real estate agent is there to help you do. Now, the next step, of course, as you're applying for the mortgage, your application essentially will provide us with any remaining financial information we'll need and lock your interest rate until the closing date. So, once you're in contract, you get an offer accepted. We'll take that application that you already have, and then that's what we're going to actually submit to underwriting. The person who makes the final decision on your loan is going to be the underwriter. That's the judge. I'm like your lawyer. The underwriter is like the judge. And so we submit that case, that file, that application to the judge so they can give us that approval. Right. And then at that point, we'll also look into locking in your interest rate. Now, a few home buying do's and don'ts. Okay, we'll quickly go over this, but here are just a few tips to help avoid problems while purchasing a home. So, do's. Now, do inform us of any changes in employment or compensation. So, if you're changing jobs, if you're getting a raise, or if you're losing a job or getting a pay cut, please do tell us. We need to know that. We need to know that as soon as possible. That can either improve our purchasing power or hurt our purchasing power. So we all need to know that, just like I said again, so there's no surprises. Do continue to pay your rent, your mortgage, and credit cards on time. So you don't want to be late on anything as we're going through this process because towards the end of the transaction, we'll do one more what's called a soft credit pull just to check, just to make sure, as this is pointing out to, that there is no late payments, there is no new loans that got taken out right before we're about to fund the loan. So just make sure that you're continuing to make your monthly, debt obligations on time and you're paying everything on time and nothing is being missed. Also, keep a paper trail of any money that's being moved from account to account. So if it's an account that we're going to use to draw money from in order to use to purchase or facilitate this transaction, if any money, large deposits are moving in and out of the account, keep a track of it because we're going to need to document it. So the less movement in that nature that's happening is, would require less paperwork. And again, of course, this is kind of a no-brainer. It's just, notify us of any changes, but you kind of have to just repeat it and just make sure it's said. But please notify us of any changes in your finances. So if you are going on a disability leave or something like that. Or if you're, deciding to, I'm going to start taking a distribution from my IRA, or I'm going to take a loan from a family member, things like that. We just need to kind of know. Also, notify us of any travel plans during the application process. That is very important because if you decide to leave during escrow, we need to get in contact with you. That could really, really damper our efforts to get you this loan in a timely manner. Because once we do get into contract, um, you know, the clock starts ticking, things start moving really fast, and being able to communicate with you quickly is very important to ensure the quality and just to ensure that we close the transaction in a timely manner. Now, some big don'ts. Now, please don't quit your job. Okay. Don't do that. Don't quit your job. We need your job. We need you to be employed to qualify for a loan. Again, we need to show you have the ability to repay the loan. So if you don't have a job, it's not really showing us that you got the ability to repay the loan unless you just won a lottery or something like that. And if you did that, most likely don't need a loan. But now, now don't co-sign for anyone. Now, if you have a cousin or your daughter or your girlfriend or something like that, it's like, hey, come on, co-sign for me for this new car or this new student loan. You're gonna have to tell them, hey, not right now. After I get done with this loan, then we can talk about doing that. But during the loan process, do not co-sign for anybody. All right, it can hurt you. Now, don't transition from your current employer to self-employed because if you do that, it just sets the clock back in terms of what we need in order to qualify your time of employment. So remember, we need 2 years. So if you go from being a W-2 employee to now self-employed because you got this marvelous idea to, forge ahead on your new, business idea, well, now we don't have a track record or history of your new business idea. So that clock starts back to zero. So that could really hurt us as well. Now, don't apply for or close out any credit cards. So we briefly talked about that. Don't apply for any new credit cards, or don't close out any old credit cards is also very important because we want to keep that payment history intact, and we want to be able to see that to show to the underwriters. Don't max out any credit cards. Try to maintain a low balance and avoid large purchases. We talked about that. And don't move funds from account to account. All transfers will require a paper trail. We just talked about that. So that's that. Those are your home buyers' do's and don'ts. Okay. Now, quickly, what the now the underwriting and appraisal. Now, the underwriting and appraisal portion is where we're going to verify your application information, assess your credit and collateral, order the appraisal, and ensure essentially that you're not overpaying. Okay. So here's how the underwriting process looks. So, like I mentioned, the underwriter is the final decision maker on your loan. That is the judge. Okay. So the underwriter The underwriter will complete an initial review within about 48 hours of receiving your file in their queue. Okay. Now, if there's any conditions, okay, so conditions meaning like items that need to be satisfied to move forward with this loan, if any conditions are required, we will we will work with you to clear those conditions within 2 days. Okay, within 2 days, we want to get this thing cleared if there's any conditions. Okay. Now, we want to do that just to ensure that there's no delays within escrow and make sure that we close your transaction on time. Okay. Because the main thing that's at risk is the earnest money deposit that you use to open up escrow. All right. Now, your loan will return to an underwriter for final review and a clear to close. We like to call that the CTC, clear to close. That's the email that we all, live and hope for, is the clear to close, meaning that the underwriter has fully approved your loan and is ready to send it through funding now. The processor will inform all parties of the clear to close and verify the closing date and time. Now, close of escrow date will already been determined once we open up escrow, but that at that time we'll have a just a more accurate time in terms of like when the signing is going to take place and when we're actually going to close escrow, and we can just time this all up and line it all up just to set the proper expectations for everybody. Okay, and then after that, it's closing, baby. Okay, it's time to celebrate. After all the paperwork is signed, you're going to receive your keys to your new home. And that's it. Okay. That's it. You're going to receive the keys to your new home and you did it. You did it. You are absolutely now a new homeowner. Now, arrive prepared when you become that new homeowner, when we start jiggling keys in front of you. Okay. Plan to review all the final documents to confirm the rate and loan amount. Bring a cashier's check or pre-arrange a wire transfer to cover the closing costs and down payment. Also, bring your photo ID and possibly a social security card to confirm your identity. This is for the closing. Okay, so let's back up. Let's edit this. So now, after the processor has informed all the parties of the clear to close and verify a closing date and time, we now have entered into the closing section of this transaction. So it's almost time to celebrate. After all the paperwork is signed, you're going to receive the keys to your new home. So at the closing, okay, when you essentially go to sign the loan documents, arrive prepared. So these are some of the things that you're going to have to prepare for. So prepare to plan to review all of the final documents just to confirm that the rate is correct that you and the loan officer talked about and went over. Confirm that the loan amount is correct as well. You should have talked and reviewed all the stuff with the loan officer prior. Also, bring either a cashier's check. A pre-arranged wire transfer can also be done at your local bank, so you can cover like a closing cost and any remaining down payment requirements. And then also bring a photo ID just to, confirm your identity and potentially even your social security number as well, just depending on, what the circumstances are. But that'll all be communicated to you from your loan officer or someone within the team. Okay. And then real quickly, just so we know, like just the difference between what a home inspection versus a home appraisal is, we'll walk through this real quickly. So a home inspection, what is it? So the home inspection, as we've discussed, it determines the condition of the property that you're buying. Okay. A home appraisal, it determines the value of the home that you're buying. Okay. The home inspection, when do you get it? Okay. You order an inspection after your offer is accepted. That's when you get the inspection done. For an appraisal, we'll order an appraisal when your loan is in underwriting. And that's not all the way true because as soon as you get into contract and you've deposited your EMD number or EMD funds in escrow, we'll order that appraisal as soon as we possibly can. So that typically is what our process is. How much does it cost for the home inspection? It's going to cost you between $250 to $400, just depending on the scope of the home and the inspection and the size of it. And then for a home appraisal, same kind of thing, depending on the size and the scope of the work needed to be done. It could cost you between $450 to $600. In some cases, it can even get up to $1,000, just depending on the type of home it is. But then this is just a quick overview of all of the closing costs that you're most likely encounter when you're purchasing your home. Okay. So some of the costs that you may come across is an origination fee. This is a fee paid to a lender for processing a loan application, generally between 0 to 1% of the loan amount. We do not charge an origination fee for our conventional loans because we're a direct lender. However, if it is a more creative product or creative program, that can vary. Title and insurance and fees. This ensures the transfer of ownership and protects against financial loss in the event of a future claim on the property. So we talked about that. So the title insurance just makes sure that no one else, after you purchase the property, can come and claim that they own the property. So a part of the whole title work that's done is to ensure that the seller is the actual owner and has the right and the ability to sell you the property, you being the new owner. All right. Prepaids, these are the prepaid interest we spoke about, covers mortgage interest that's due between your closing date and your first mortgage payment. All right. So this may also include your first year of homeowners insurance if you're incorporating your homeowners insurance within your monthly payment. Escrow cost, these are going to be fees to set up an account where a 2-month reserve for property taxes and homeowners insurance is collected and held for payment when due. Now, depending on the month that we close the transaction, could determine how many months in property taxes that we need to collect in order for escrow to pay taxes in your monthly payment every month. Okay, if there's a calendar out there, and here I'll even share that in the description as well. So just take a look in the description below. Appraisal fees. We've talked about appraisals. So the cost of an independent appraisal for the property, transfer taxes. This is so depending on what city that you're buying or purchasing in, the county or the state fee for the change of ownership in property, they charge a fee for that. So that'll be determined in once we get into escrow. Recording fee, this is a fee that's paid to the recorder's office. So to record the deed, it's pretty inexpensive, like $8 or something like that, $25. So that's part of the closing cost. Points, these are fees that are paid for the lender for a reduced interest rate. So these are called discount points. And you can pay that, within your closing costs to reduce, interest, your interest rate. And I can help kind of determine if that is even a feasible or cost-effective thing to do. And then other fees, anything else, you may have to pay at closing, of course, just ask me, let me know, and we can go over it. Okay. That's it. Okay. So those are the tools. That's what you needed to take the first step in home ownership. Okay. So what I'm going to offer here now is if you need to get going, feel free, you can leave and please, circle back with us and check in and see if there's anything that will be valuable to you. I still want you within our, Cadet Mortgage family here in our Blossom Home community that we're starting here. And so check in with our social media places. We're working on a first time really just a home owner and a home buyer community. It's going to be called Blossom Homes Community. And check that group out on Facebook. So, if you need to get going now. But for those who do want to stick around, I do have a special offer for you. And essentially what this offer is going to do is essentially take the information that you just learned today and actually put it into action. Okay, so in the description box, what there is there's going to be a link that you can go in and click on, that you can click and set up a discovery call with me during whatever available times that I have. on that calendar. All right. So if you schedule a time with me to do an assessment and we figure out if we can get you qualified to purchase your home, or whatever the case may be, if it's whether, for an investment property, your second home, but really this is really more geared towards first time home buyers, give me a call and schedule that discovery call. Okay. And during that call, I'll even share with you another offer that I'm going to give to you, and some things I think will be very, very valuable to you. So things that, again, that are going to be valuable to someone who's aiming to purchase their home is going to be the information. And information, good information, is not always easily accessible, nor is it free. And I'm doing that. I'm giving it to you for free. All I ask is that you just schedule that cleanup call with me, and we can take it from there. Okay. But again, that's all my contact information. If you had any questions or direct just scenarios that you wanted to go over with me, just shoot me an email, shoot me your scenarios, and we'll see if we can make some magic happen. But again, this is Michael Cadet, your boy from the Cadet Mortgage team at Cross Country Mortgage. I am signing out. Thank you so much for joining me today. You guys have a blessed one. Peace.